Coming up on Market to Market, President Obama voices his support for a portion of a controversial oil pipeline. Private analysts gaze into the crystal ball prior to USDA's prospective plantings estimates. And thousands of workers migrate to North Dakota, where an oil boom is rocking in the Bakken. Those stories and market analysis with Jamie Kohaki next.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.
This is the Friday, March 23 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. This week's batch of government reports were mixed in their assessment of the U.S. economy. According to the Labor Department, new applications for unemployment benefits fell last week to their lowest level since March of 2008. The less volatile four-week average of applications, meanwhile, matched a four-year low. Separately, though, the government reported sales of new homes declined more than 1.5% in February and are down 7% since December. Existing home sales also declined last month, but the National Association of Realtors reports January and February comprised the best winter for sales of previously occupied homes since the housing slump began 5 years ago. Rising energy prices, however, pose a serious threat to the recovery. Crude oil prices jumped nearly $3 in 13 minutes late this week as news circulated that Iranian oil exports are down nearly 15% this month. And the national average price for gasoline stood at $3.89 per gallon Friday, an increase of 20% and an all-time high for March. While many economists suggest there is little that politicians can do to cut gasoline prices, the electorate has a tendency to think otherwise. And late this week, President Obama traveled to the heart of oil country to outline his energy policies and voice his support for a portion, albeit a not-so-controversial one, of a major oil pipeline.
You just tell them, anybody who suggests that somehow we're suppressing domestic oil production isn't paying attention.
Promoting everything from domestic crude oil production to solar power, President Barack Obama spent the past week crisscrossing the country in a series of energy-themed tours and public speeches. Standing at the epicenter of American oil, Cushing, Oklahoma, Obama pledged full support for the southern portion of the Keystone Oil Pipeline.
And today I'm directing my administration to cut through the red tape, break through the bureaucratic hurdles, and make this project a priority. To go ahead and get it done.
Obama's support of swift government action on the Keystone XL pipeline is constrained to the route's southernmost portion, running from central Oklahoma to oil refineries on the Gulf Coast. The administration still argues the northern portion from Canada through the Dakotas and other Midwestern states will receive fair bureaucratic attention once an alternate route through Nebraska is chosen. In 2011, the Keystone XL hit its largest production snag, not only in Washington, but in the Cornhusker State, where bipartisan concerns over pumping oil near the Ogallala Aquifer raised concern from rural and urban citizens. But there is a growing consensus in Nebraska and Washington that the Keystone XL will find an alternate, environmentally friendly route and receive eventual government approval. Pipeline owner TransCanada will begin construction on the southern route in June, but the president's support was not surprising considering the southern portion of the Keystone was never as controversial as its northern section. Republicans blasted the president's embrace this week as little more than a publicity stunt. A spokeswoman for the Republican National Committee said the American people can't afford more half measures on energy from the president. No matter what he says, the reality is he killed the Keystone Pipeline and the energy production and 20,000 jobs that went with it. Environmentalists, long critical of oil collected from Canadian tar sands, piled on the president, arguing the petroleum industry has a history of oil spills. But with gasoline prices continuing to rise, the Obama administration has launched an election-year assault on energy in the public sphere.
Since I took office, our dependence on foreign oil has gone down every single year. Last year, we imported 1 million fewer barrels per day than the year before. Think about that. America, at a time when we're growing, is actually importing less oil from overseas because we're using it smarter and more efficiently. America is now importing less than half the oil we use for the first time in more than a decade. So the key is to keep it going.
Since the U.S. produces slightly more than 10% of the world's crude, some experts believe increased domestic oil production will make a minimal impact on gasoline prices. But that's not to say increased drilling can't have a profound effect on local economies. And nowhere is that more apparent than in North Dakota. While virtually all of its neighbors are mired in budget deficits, North Dakota enjoys a state surplus of more than $1 billion. Unemployment is just over 3%. And over the past decade, North Dakota employers added 50,000 new positions to their payrolls. Many of the workers were lured by the call of crude in the Bakken Formation. And as Paul Yeager discovered last fall, oil isn't the only thing gushing in North Dakota.
Two years after the worst downturn since the Great Depression supposedly ended, America continues to claw its way back from the economic abyss. There is one place, however, where unemployment is virtually non-existent, state coffers are bursting, and a diverse economy is growing almost exponentially. Welcome to North Dakota, the state the recession forgot. With an annual economic impact of nearly $7 billion, agriculture accounts for 30% of the state economy. But an oil boom in the western part of the state now is bringing big trucks and big hopes to North Dakota. And nowhere is that more apparent than in this formerly sleepy town of Williston.
Obviously, there's some real challenges, and we would like to grow a little slower. You could control what's happening.
Ward Kozer has seen dramatic changes in his 17 years as mayor, but nothing could prepare him for the seismic shift that began when the first commercial rig drilled deep into the Bakken Shale Formation in 2006. In the ensuing 5 years, more than 200 rigs took root in the western part of the state. Rumors now are circulating that 50 more wells could soon be drilled in the region, and Kozer is a bit concerned for the 20,000 people who now call the Williston area home.
Each rig brings anywhere from 80 to 100 workers with it, and then you get all the extra things that you need, the stores, the restaurants, all the things there. And we're really being pushed to the limits. A big increase in rig count would really challenge us.
In addition to drilling rigs, countless oil jacks dot the otherwise mostly barren landscape, working around the clock, pumping black gold from deep within the earth. But it's the technology deployed on the drilling rigs that has set up a classic oil play in the Bakken. New, and in some respects controversial, horizontal drilling and fracturing methods are unlocking billions of barrels of heretofore inaccessible crude. The procedure, more commonly known as fracking, begins by drilling vertically until workers reach a zone of interest. They then gradually drill to a 90-degree angle. Cement casing is then installed and small fractures are created. Finally, sand and water are injected into the voids, allowing oil or gas to flow into the wellbore.
This technology, being able to go down 2 miles and out 2 miles with the technology to put that drill bit inside a coffee can, down and out 2 miles, 4 miles total, has really changed the game.
As head of the North Dakota Petroleum Council, Ron Ness has seen the North Dakota oil industry expand dramatically in his 13 years on the job, and he says the growth is accelerating.
I didn't think this industry would be where it was 6 months ago today. We keep having to recreate ourselves. The expansion, the ability to take a basin that's producing 100,000 barrels of oil a day and now go to probably 450. This is serious oil. We're just getting started.
Though virtually non-existent 5 years ago, oil production accounts for about 25% of the state's economy, but its share is growing every day. Oil speculators, however, aren't exactly new to North Dakota. The state enjoyed similar booms in the 50s and late 70s, but as the holes dried up, so did the economy. This time around, though, officials say things are different.
We think it's going to take about 33,000 wells to produce this oil field. And so we're not even 10% of where we need to be when we get to the end of this drilling phase.
As director of the Department of Mineral Resources, he oversees regulations, permits, and surveys of oil and natural gas sites. And Helms predicts things are going to be rocking in the Bakken for quite a while. In May of 2008, when North Dakota's total oil production was estimated at 4 billion barrels, Helms delivered what he calls his "this is going to be enormous" speech. His outlook was criticized at the time for being too optimistic. But Helm says he actually understated the future of fracking.
That speech actually underestimated what's happening by about 50%. Our estimate of the amount of oil in this Bakken formation just in North Dakota is 170 billion barrels. We think we can get about 11 billion of those barrels out. If someone can come up with a way to just increase the recovery of this oil 1%, that'll be another billion barrels that we'll take out of the ground. So this thing has a very long life to it.
But the blessings of oil are not without their own set of burdens. Housing is a major problem. Campers are parked on just about every available space. New developments are under construction, but builders can't complete them fast enough. In the last fiscal year, the city of Williston issued $220 million worth of building permits, 10 times the state average for a community of its size. But for those lured by the call of crude and lucky enough to find housing, opportunities abound. Trucks literally outnumber workers in Williston. There are no vacancies at any of the local hotels, and infrastructure is being stretched to the breaking point. Roads are deteriorating, crowded, and by some accounts, dangerous. Nearly $2 billion in newly allocated state funds will help, but will likely be insufficient to accommodate the Bakken's enormous potential. While state coffers are brimming, officials are reluctant to sign blank checks.
We had an 8,000% increase in our Department of Transportation budget, and a large amount of that was one-time infrastructure spending to meet the demands. You got to be prudent in your decision-making.
Fresh water supplies are ample thanks to Williston's proximity to the Missouri River, but the local water treatment facility is woefully inadequate.
We literally have sewage coming out our ears. We have grown so rapidly, and we need to be expanding, and we're trying to expand.
Rather than wait for government solutions, some companies are taking matters into their own hands.
Got a company in Watford City, North Dakota, Badlands Power Fuels. 2007, he bought the business. He had 20 trucks and 40 employees. Today he's got 600 trucks, 850 employees, building 400 and some apartments, houses.
While the potential is not without pitfalls, North Dakota officials are aggressively embracing the call of crude. And with the nation's lowest unemployment rate and the economy that is the envy of virtually every other state, they claim prospects for prosperity also are high.
The thing that I always drive home thinking about is that we're only 10% into this thing, and that 90% of the work is still in front of us. 90% of the production is still in front of us.
While it is difficult to overstate the economic impact of the oil boom in North Dakota, experts say increased U.S. production has little effect on retail gasoline prices. Next week, we'll examine why efforts to extract more crude from domestic locations could fail to alleviate the pain at the pump. For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
Wheat prices plunged early this week after Russia decided against limiting grain exports this year. Russia's prime minister says the nation has overcome problems blamed on severe drought in 2010, which prompted a ban on grain exports, and officials predicted this year's exports might reach 27 million tons. Nearby wheat prices fell nearly 20 cents and settled just above $6.50 per bushel on the news on Monday. Other factors affecting the outlook include Mother Nature and, of course, the Agriculture Department's prospective planting estimates. And ahead of USDA's release of the much-anticipated report next week, private analysts have been making a few guesstimates of their own.
Private analytical firm Informa Economics is pegging corn acreage at 95.5 million acres. That's up less than 1% from the company's January estimate of 94.8 million acres, but is 4% higher than last year's official USDA figure of 91.9 million acres. Corn processing giant ADM puts the corn number closer to 94 million acres, while futures trading company PFG Best predicts 94.5 million acres will be planted in the coarse grain. Soybean acreage also is expected to rise over last year. Informa predicts 75.2 million U.S. acres will be planted in the popular oilseed. That's a mere 150,000 acres above the Tennessee-based company's January estimate and the figure is slightly above USDA's 2011 tally of 75 million acres, which ADM prognosticators see as the correct amount for 2012. Total wheat plantings are anticipated to be 57.7 million acres by Informa. That's 6% higher than last year's USDA figure of 54.4 million acres. And ADM predicts total wheat acreage will increase nearly 7% over last year to 58.2 million acres.
Large bands of precipitation rolled through much of the Corn Belt this week, prompting grain futures contracts to give back virtually all of last week's gains. For the week, May wheat lost 18 cents, while the nearby corn contract moved 27 cents lower. Despite long-term bullish export numbers, soybeans also were pressured as the May contract settled Friday with a weekly loss of 8 cents, and nearby meal prices declined to $1.40 per ton. In the softs, cotton bucked the bearish trend as the May contract advanced $2.15 per hundredweight. And in the dairy market, April Class 3 milk futures declined 34 cents, while the May contract moved 44 cents lower. In livestock, the June cattle contract lost $1.62. Nearby feeder cattle were off nearly $2.50, and the June lean hog contract declined $1.38. In the currency markets, the euro gained 97 basis points against the dollar. Crude oil declined 71 cents per barrel. COMEX gold advanced $6.60 per ounce. And the Goldman Sachs index gained less than 1 point to settle at 703 1/4. And here now to lend us his insight on these and other trends, one of our regular market analysts, Jamie Kowalski. Jamie, good to have you with us.
Thanks, Mark.
I want to talk about that wheat thing for just a minute. Russia's announcing kind of early that they're going to approve they're not going to slow down their export number, and they've had some weather issues. They had some other challenges over there in that part of the world.
That's right. You could just go back here about 90 days. They were 30 to 40 below consistently for about 2 weeks. So, yes, I agree that they might be jumping the gun here, assuming that they're going to have enough crop to support their own supplies, which was the concern last year when they shut down their exports.
That's right. Of course, that was a catalyst for a big move in the grain markets when that happened. Obviously, the big number that everybody's looking at right now is what's going to come out from the USDA. The acreage number is going to be a fascinating one to talk about, but we know from history that the intentions don't always turn out to be what is actually planted. Let's talk about what you see first, and let's talk about the wheat market. What do you see? What kind of acreage number I think we're going to see from the government?
Right. I think the wheat number is very, very close to what the number ADM just showed there. I don't think there's going to be a big jump there. We've seen the wheat acres drop off quite drastically the last few years. Wheat right now is a follower of corn. There's not much going on there. I think you saw sharp rallies here short term, but it's going to follow corn. The key is going to be, can the dollar stay below 80, keep export business up? What type of feed grain is China buy? They bought 350,000 tons from Australia this week, and how that with the Baltic Sea area plays out as well.
That's going to be interesting. And the fact that they bought feed wheat, kind of wonders if that's going to blunt some of this potential corn demand too from China.
Right. The stories this week were that the government is buying the feed wheat. Private companies are still wanting U.S. corn. China's corn prices are just shy of $10 a bushel still. Numbers on their production for last year that are out right now were a bumper crop. I don't believe that they're accurate. They harvest a wet crop. They put away a wet crop. Serious quality issues. And then overnight, Thursday night, we saw reports of Bloomberg putting out that the numbers might be off for the last 3 years. And that would not surprise me either. So I think China is a long-term buyer of corn and beans from us.
But like you say, this wheat buy was interesting. And the strategy that the government's taking over there. So wheat prices at this stage of the game, pull back this week. What's your thinking? Where are we going?
I think we see one more pop in the corn market. I'm not selling 555 new crop. I like 570 December, 575. I would sell into that before next Friday's report. If you got some old crop to sell, I'd look at 660 pre-report. I think the old crop is fine though. Continue to see the stocks shrink. Bull spreads have been heavy traded by May, by July, and sell December.
Where do you see as far as the corn markets going, and what kind of an acreage number do you think we'll see on corn?
I'm at 94.8 right now. I think 94 is in the market right now. I don't think you're going to see a big number yet. I think 95 is pretty much a high side. I'm thinking the USDA will come in at. The key is going to be fund liquidation. Producers, speculators, I think will be lined up on the short side. So the key will be if the fund's going to dump a lot, if the numbers come in really bearish to make a limit move or not.
All right, and of course, we've also have another USDA report that comes out that same day.
Right, we got our ending stocks numbers. That might take a little bit of a back seat to the acres, but old crop, I think we're not going to see that much separation there. We're going to see liquidation if it is bearish across all entire contracts.
And that report has been a shocker in the past, so.
Yeah, the USDA's got a tendency here the last 2 years of, in the carryout numbers of being erratic, and I wouldn't be surprised to see another one here Friday.
All right, and your corn outlook again is what?
I'm selling rallies, 570D, 660 old crop.
Oh, that's right. You're giving me your corn numbers there earlier. I was expecting wheat numbers. You gave me corn numbers.
Wheat numbers, I'm sorry. I like 720, that area.
Okay.
What I'm concerned about with the wheat is a lot of green wheat is coming out fast, hard, still susceptible to freeze. So I'm not getting too antsy selling wheat right now. I'd wait and see if we can get one more rally to sell into.
All right. And your corn numbers again, just ballpark, you want to sell that decent 570.
570.
You want to sell 20%, 40%?
15 there.
15.
I'd do another 15 up around 580, 583. That's your next resistance level above that.
All right. A lot of talk. It seems to be good ethanol demand for corn going forward. Talked with Bob Wisner this week at Iowa State, who says that's coming on strong. Maybe more DDGs in the export picture, maybe some exports for ethanol. So good demand there. Again, if China materializes, that could be the catalyst of this corn market.
Right, and I think that's why you're going to continue to see the old crop outrun new crop with all those numbers staying firm. Ethanol, though, is running about 2% behind last year, but it's not a big drop off yet. $4, $3.80, nationwide gas, I think is here to stay short term, so that should help out as well.
All right, and again, as far as the corn market is concerned, old crop, you're not in a hurry to make sales right now?
I would sell a little bit at 660. Sell another 10% of what you have left pre-report up around the 660 area at May.
All right, soybeans.
Right now, the beans, old crop beans, probably the most bullish in the whole entire grain sector. Seeing the same thing here, a lot of bull spreading, buying old crop, selling new crop, buying new crop beans, selling new crop corn, a ton of spread action. The key is going to be exports here with China. When do they shift their demand to South America? And I know how long does that take to process down in there? Brazil is about 40% harvested. Argentina's getting started. Brazil's numbers are continuing to shrink. Their crop is getting smaller and smaller. Pre-report, I would be looking at 1340 November. If you're nervous of a bearish report coming in there, plus 75 million acres was where I would lay some off at.
All right. Okay, so some good strategies there. And you mentioned the fact that the Brazilian numbers continue to shrink. That's been a trend, Jamie, almost yearly, where we thought we had a big crop coming in on there, and then it's continued to shrink as reality sets in.
That's right. We start up in the low 70s for the crop size, end up in the mid 60s, low 60s. But Brazil is by far the worst bean crop down in South America. Argentine numbers, I don't think, are going to be anywhere close to as bad as Brazil's are.
I want to talk real quick about cotton. Up move this week. What's your thinking there? I mean, we've had the situation with India. We've had this global concern about cotton demand. What's going on?
Seen some short covering finally. I saw a big downtrend, like you're saying. Market got a little overbought and finally seen some profit taking. I would sell some December up around 93 is where I would be at in cotton. I think the key is to keep the dollar weak below 80 to keep enticing foreign exports.
Absolutely, very export sensitive. As is the livestock sector anymore in the beef market. What's been the sell-off in beef? We seem to have a good rally going. We seem to be, beef demand seem to be holding up, and the futures have fallen out of bed, and the cash weakened up some too.
Right. The cash market finally came back a little bit this week, steady to dollar higher, which was nice to see. But what happened was the market got way overextended, overbought, was due for a correction. Was the $8 sell-off too much or not? Probably so. We did try to catch a couple minor technical bounces this week, but did not hold on Friday. We saw new lows put back in for the move and came back up and closed above the recent lows, but still in a downward trend short term. I would look up around 132 for October live cattle as a sell point. I don't like where we are right now. We saw two bearish reports this week, cold storage on Thursday and also the cattle on feed on Friday. I think both of those numbers should be in the market come Monday morning, and hopefully we can get some more short covering next week to be able to sell into.
I'm just calf market broke down too, in spite of the fact that we had a break in corn prices.
Right, close to an $8 sell-off there in some of the contracts. Feeder cattle market got more technically overbought than the cattle, live cattle contracts did. What I would look at is back up around 160, 161 to be a seller there. I don't like chasing these lows, recent lows, hoping for more of a short-term correction. Technically, we're too overdone in here.
All right. Real quick on the hog market, what do you see happening there? That's become so export dependent. This dollar is critical in this.
Right, and we're not seeing a big sell-off in the weekly pork or beef numbers. Pork is still cheap to the beef and the chicken market right now. Hogs are having a hard time separating themselves from the cattle market right now. I'm not worried about hedging down in here where we're at. I'm actually looking at selling like some June 86 or even $88 puts. Just collect that premium, looking for a correction to sell into. I did on Friday take some futures hedges off, short ones, and converted them to options, just thinking that we might be close to a short-term bottom and wanted to bank those profits.
All right. Okay, good strategy. But let me ask you this: with the time we have left, which isn't much, talk about crude oil. What you see happening there? Obviously, we had this spike up, and you look at it from a technical standpoint, and you think, "Ew, that spike up looks like it could be foreshadowing something." Is it?
It could be, but we came back down and settled right pretty much smack dab in the middle of the daily range on Friday. I think we're still in the 104, 109 range right now. Dollar and the geopolitical stuff with the Middle East is the key. The big news pretty much in all these broader markets, metals, energies this week was the PMI index coming out of China. We saw a 1% lower number there than what was expected. And that's a signal for deflationary markets. I don't think crude's ready for that, but metals, I think, are close in here to seeing some more fun money come out.
All right. 15 seconds. What's your trade of the week? Is one trade you'd like to make this week?
Speculation-wise, I like those hog puts, those 86s in June, selling those is right on top of my mind right now.
All right, so some hog puts might be an interesting way to go. It's going to be an interesting week. And gold futures, real quick, you think you're going to pull some money out?
Right, I think funds are going to see some liquidation there. If you're long metals, I'd be looking to take profits on rallies.
We got to go. Jamie Kawaki, thank you so much. That'll wrap up this edition of Market to Market. If you'd like to learn more from Jamie, by all means, join us on our website where you can see our Market Plus page. You'll also find expanded market analysis, audio podcast, streaming video of our program, and, of course, links to our Twitter feed and Facebook page. And it's all free at the Market to Market website. And, of course, we hope you join us again next week when we'll examine the impact of increased domestic oil production on gasoline prices. So until then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.